So I have 3 cheap stocks to buy in 2020 in 3 different industries. Hey, and welcome back to another video here at FiscalVoyage. My name is Felix, and in this video I'm going to provide you with 3 cheap stocks for 2020 to buy now that are very undervalued, has a great dividend yield, and it's very safe as well. But before we get started, if you're new to the channel, make sure to hit that subscribe button, and also please check out my free ebook that I have in the description below with 5 quick metrics to look for before you spend more time in researching companies.
This Group, the company is in the life and health insurance industry with a market cap of $3.8 billion and an S&P credit rating of BBB, which is investment grade, and a very low, not very low, but a modest to low debt to cap ratio of 24%. Currently, as you can see here, the company has almost a dividend yield of 6%, and I think it's 6% now because the company is down about 2% today as of 12/30 August 17th. And the biggest key thing that I see here with Group is the blended PE of 3.6 and the blended adjusted earning yield of 27.7%. That is outstanding. That's the great indicator that this company is very, very much undervalued. And let's look at the fast graph fundamental charts here. As you can see here, the only year they really had a decrease in earnings was in 2003, where it had a 35% decrease from $253 to $165 a share. But ever since then, earnings has been at a very nice rate of growth. You can see here the most recent decrease is going to be on this year, of course, with the economic shutdown and a very low interest environment. But still, this doesn't concern me actually, because Group is one of my biggest positions. I've bought a lot of shares during this time frame, and I'm looking forward to once the price starts to appreciate, because as you can see here with this chart, the company tends to follow this blue line based on this long-term valuation or fair value about of a 9.4 PE. As you can see here, it has a PE of 3.6, but if we shorten the time frame, the PE does drop at 8.8 versus the 3.6 currently. But let's give it at a 3-year time period. As you can see here, if we go to the normal PE of 8.7, where it is now, we can have a total annual rate of return of 55.2% annually, which includes capital appreciation and dividend. So this is one of the big reasons why I find this company as the top 3 cheap stocks for 2020. As you can see, even though the earnings is not growing at a substantial rate, for example, this year it's going to be down about 4%, and next year an increase of 3%, but then 2022 a nice increase of 10%. And Atlas has been pretty accurate with calling these predictions. As you can see here, the 1-year estimates is about, the company hits it about 91% of the time, or beats it the additional 9%, and that 2-year prediction, the company hits it 100%. So I'm very, very, very confident that these estimates are very accurate. So that's why this is one of the top 3 stocks or cheap for 2020 and beyond, because again, it may not go anywhere this year, but I think the following year and the year preceding that, the company will start increasing the price. But the great thing in the meantime, you're going to hold this safe dividend, which is almost 6% as today. So let's look at how safe the dividend is, because if we look at the free cash flow, you see here the free cash flow very, very much covers the dividend, and they've been increasing free cash flow in 2019 and 2018, 36% in 2018 and 20% in 2019. We don't have an estimate for free cash flow for 2020, but I'm pretty sure it's going to be very covered, the dividend, because the company has been announcing the past 2 dividends so far. So the dividend cut is very unlikely, and they have a good credit rating as well as long-term debt to cap ratio. So the likelihood of dividend cut is very unlikely, and again, you get a 6% yield with a very nice valuation. So let's say, for example, if the company doesn't hit that valuation of 8.8, but let's say even if it has a valuation of 6, if we apply that custom valuation ratio of 6, you can see there was period of times where the company was either close to 6 or under 6, and this was in 2008, 2009 financial crisis. So you can see here it went to a PE of 4, and then it went right back up and increased since then. But as you can see, since the beginning of the year, the company dropped substantially, of course, because of the economic shutdown and all the things going on. But if we were to hit that PE of 6, you still have a total annual rate of return of 33.8%. So this is why I feel this is one of the big companies that's very undervalued. Great dividend yield, safe dividend. So it's something you guys should definitely look into. So let's look at some of the fair value prices from different analysts. CFRA has a fair price of $52.03, Morningstar $29, FastGraph, we just saw, $45, Yahoo at $20, and dividend discount model analysis at $25. I use a 7% dividend growth for the next 3 years and 5% after that with a discount rate of 10%. That's how I got this number. And averaging out to 5, we get a fair price of $34.50. And currently, the company goes for $18.70. I mean, it's undervalued by 84.5%. And that, of course, is because, as you saw, even if the company was to hit a PE of 6, which is still very low, the valuation of the company is just enormous. So this presents a big opportunity. So make sure to do your research on this company. I personally own shares of this. It's probably one of my biggest position of this company, and I've been buying it in the past few months. So I'm looking forward to the next 2 years, 3 years, how this company is going to perform. So let's move up with the next company. So the next one here is Bistro Myers Squibb. As you can see here, when the black line again is the monthly closing price, the orange is a PE of about 15, and the blue line is the normal PE where the company tends to value at 19. But you can see here there's been periods where the company was under both the orange and blue line, and then there's periods where it was above both. And these periods were where the company was considered overvalued, and these periods were considered undervalued. And as you can see here now, the company looks to be undervalued based on this chart. And the biggest reason for this undervaluation and this high growth in earnings, for example, 33% for 2020, 18% for 2021, 7% 2022. The reason for this high growth in earnings is because of the new acquisition of Seligen. I think I'm saying that correctly. But as you can see here, we lower the time period and go see the estimate annual rate of return. We could have a potential total return of 32.5% or 33%. The company pays a nice dividend yield of 2.85%. It has a blended adjusted earning yield of almost 9%, which is good. Meets the criteria or a minimum of 6.5%. S&P credit rating of A+, a modest 44% debt to cap ratio, is a pharmaceutical company. And again, the blended PE average is 11.6, and right now the company goes for a PE of, the current PE is 11.1, and the company normal PE tends to be at 22. But if we lower this and look at the most recent years, you can see the normal PE decreases to 18. So even with the 18 PE, the company is undervalued. You could have a total annual rate of return of 43 based on this recent earnings growth. For example, in 2016, it had 41% earnings growth. 2017, 6%. 2018, 32%. So the company is growing earnings at a double-digit rate. So, and with the current acquisition, I think that growth rate is going to continue to happen. And for example, the analyst scorecard is pretty well. Company, the analyst was correct about 64% of the time, where the company beat the additional 36% of the time for the 1 year, and the 2 year, 91% of the time they hit on that earnings, and the company beat it by 9% of the time. So I'm very confident again with these estimates. So the likelihood of this company, returning you 40% of annually is very, very, I'm very confident with that. And this is why Bistro is also one of the companies that I own in my portfolio. Even if we give the company a PE of 10 for a custom, low valuation PE, you can see that it never really hit us besides in 2018, 2019. But as you can see now, there was a period here and then the price jumped, and then of course this period here, this is when I was buying shares, and it's starting to pick up. I'm positive now, so I'm just holding shares right now because I'm happy with my current position. And as you can see here, it's heading in that uptrend because the earnings growth. Price follows earnings. As long as earnings continue to grow, the price will follow it. You do have your ups and downs. Those is when you have your opportunities to either buy or sell. So right now is an opportunity, in my opinion, to buy. And I've personally been buying these shares of this company, and you can see why, because of this high total annual rate of return projection for the next 2 or 3 years. So let's look at the fair value prices for BNY. CFRA has a price target of $70, Morningstar at 68, FastGraph at 83, Yahoo at 73, and my dividend discount model analysis at 49. For this, I use a 7% dividend growth for the next 3 years and 6% after that with a discount rate of 10%. Averaging out to 5, we get a fair price of $68.77. Currently, the company goes for $63, and that means it's undervalued by 7.9% or 8%. It doesn't have a huge undervaluation, but that's okay because of the next few years' earnings growth is going to drive the price much, much higher. So the third cheap company for 2020 is AT&T. AT&T, as you can see here, has some erratic years of earnings. You can see here for 2002 and 2003, earnings dropped 5% and 34%. And then 2009, of course, with the financial crisis, it dropped 25%. 2011 dropped 4%. But ever since then, it's been increasing at a nice rate of 5-8%. No growth here, but 8%, 5%, and then 15% in 2018. But here's the kicker here. The company normal PE tends to be around 14. And you can see here, it had times when it was past 14 with a 16 PE here. Beginning of the 2000, it had a PE of 17. It got as high as almost 21 PE. And then years here, 16 PE, 15 PE. So it looks like the company, you can see here, normal PE is around 14. But some of the stats for AT&T, you can see here, it has a PE of 9 currently, with a blended adjusted earnings yield of 11.13, so that's great, and a dividend yield of almost 7%. Currently, the company has a BBB credit rating with a modest to slightly high 47 long-term debt-to-cap ratio. So if we look at the valuation for AT&T with a PE of 8.9, as you can see, is much lower than the 14 PE normal. But if we shrink this, that normal PE, it becomes, instead of 14, it becomes 13, so it dropped about a point. And if we look at a 7-year here, it dropped to 12. I think a PE of 10 or 11 is fair value for this company. But if the company returns back to the 12 PE, you could have a total annual rate of return of about 20%. You see here, so that also includes the dividend, the 7% yield that you're getting right now. Obviously, this company is not a growth company. Doesn't earnings is not increasing double-digit rate like Microsoft or Amazon. But what makes this company so attractive is the very safe and growing dividend. Again, the dividend is not growing at 8-10% a year. It's growing about 2% at a rate of inflation, which is okay for me, for example, because I own shares of AT&T and I'm very happy with it. And I'm just right now don't plan on adding more shares because I have a full position, and I like the dividend. So what I do with the dividend that I receive from AT&T is I invest in other companies. So we add a custom PE of 11. You can see here that the company is still undervalued with that custom PE. You could get a total annual rate of return about 15.2% with the custom PE. And analysts have been pretty accurate with earnings as well, so I'm very confident in all three companies' estimated earnings. You can see here AT&T has a 73% hit with the analysts' expected earnings. They miss 18% of the time. In the 2 years, again, they miss 18% of the time, but they hit it 82% of the time. So I'm fairly confident with these projected earnings. So even with a custom PE of 11, say AT&T doesn't hit a PE of 15, which if it did, there'll be a high capital appreciation. for this company, and you're getting a great dividend at current prices. But even if a modest 11 PE, you still have a great total annual rate of return of about 15% for the next 2 to 3 years. And if we erase this custom PE and say the company was to hit that 15 PE, you have a total annual rate of return of almost 30%. It's still possible because if we look here, there's been time periods where AT&T was over that 15 PE over here. You can see here there's been period with the 15 PE there, 16 PE there, 15, 16 PE there. So it's at that point, AT&T was overvalued. That's why I think a PE of 12 or 11 is very nice or very safe PE, or to be considered as a fair value. That's why even at current prices, with that PE, you have about 15% annual rate of return. So that's real positive there. And if we look at the fair value prices for AT&T, CFRA has a fair price of $35, Morningstar at $37, FastGraph at $40, Yahoo at $32, and my dividend discount model analysis at $30.31. I use a 2% dividend growth for the next 3 years and 2% after that with a discount rate of 9%. This 9% is because the company earnings or dividend is not, the yield is high, so therefore the discount rate should drop by a percentage. And averaging out the 5, we get a fair price of $35.13. Currently, as today, the company goes for $29.93. It means it's undervalued by 17.4%. So that's a very good undervaluation. And the fact that the company has a great dividend yield, a great history of paying out the dividends. The only thing that's really lacking right now in the company is their debt, and that's what I think is holding back the price. So once, as the quarters and the year goes on, the company is paying out their debt and trying to decrease it. So once they decrease it to a nice level, I think this stock price is gonna jump, as you saw there in the fast graph.
So there you have it. Those are the 3 cheap stocks to buy in 2020. I own all 3, and I'm very happy with my position. So make sure you do your research before you actually buy shares of this company. I own them, as like I said, and I'm very happy right now. They're all full position in my portfolio. And again, if you're new to the channel, make sure to hit that subscribe button and check out my free ebook in the description below. And I'll see you guys in the next one.